Good morning, everyone. Today's session we are going to see about computation. So it is like wholesome approach. We have been seeing independently how to compute salary, your business or profession, your house property, your capital gain, and we also discussed about clubbing, deductions, TDS, advanced tax. So all this put together. Now we are going to see problems related to computation of income. When we talk about this computation of income, we need to understand the process as a whole. So typically when you speak about this process, this will be the entire process of, let's say, determining what is your tax payable. So you're going to start one process at a time, and finally we are going to understand what is going to be the tax payable and refundable. So that's what we are going to understand as far as your computation goes. So what exactly it is? The first step of computation is basically residential status. So when you say residential status, it is you have resident, non-resident, and you have deemed to be resident. So all this will be categorized as your the residential status. So that becomes the first step. So starting from that, then you have categorizing income under each heads of income. So you have basically 5 heads of income, right? So first we need to classify, okay, this comes under salary, this comes under income from other sources. So you're classifying under 5 buckets of income, classify it accordingly, and then compute each head of income. So you compute salary, you compute house property, and each head of income. Then what you do, if there is any clubbing of income that you're responsible for spouse income or daughter-in-law's income or minor's income or any other person's income, so that needs to be clubbed. So on this income, you're going to provide for set off and carry forward of losses. So you're going to provide set off and carry forward of losses. On this, you're going to apply the tax rate, whatever is applicable. You're going to calculate the gross total income. So you're going to identify the gross total income after setting off the current year losses and the carry forward losses. In this, you're going to provide deductions under Chapter 6A. After that, you get this total income. So you'll get the total income of this particular assessee. You'll have to apply rates. When you say apply rates, you have the regular old rates. You have the new provision under Section 115 BAC, which we'll be discussing it. So this is also needs to be done. So you need to see whether it has to be applied in the regular rate or under Section 115 BAC. It's a concessional rate to certain assessees based on certain conditions. So we'll see that. Then if they're eligible for any rebate, for example, up to 5 lakhs, they're eligible for rebate, and all those things needs to be considered. So with that, you get whatever you have calculated the rebate, you calculate the tax, you provide rebate. And if there is any surcharge or health and education cess, we provide for that. There is another concept called alternate minimum tax, which also needs to be looked at. Basically, alternate minimum taxes. This is what income tax says that I need to pay. Yes, agree. But income tax says at least pay minimum of this tax. At least pay minimum tax of this in certain situations. We'll discuss that also. So you go through this alternate minimum tax and look for any, whether you are available for any concessional rate or something. Whatever TDS credit you have, then finally you arrive at the tax payable. So this is what you will have to do at a wholesome approach. It looks like a long process or whatever. We'll see each one independently. How do you actually go by each of these steps? Whichever is primarily, we'll discuss. So typically, as we said, before going into these steps, we'll understand what do you mean by the total income. When you say the individual as himself, it is the 5 heads of income. When you're talking about a partner of a firm, it will be your whatever income you're talking about, plus if there is any remuneration from partnership firm, in whatever name you call it, it could be remuneration in the name of salary, bonus, commission, whatever name you call it, it shall be included in PGBP. Though it is salary, we have discussed this earlier. When you talk about partnership, the relationship between the partner and the firm is not employer-employee. So salary, bonus, or whatever you give as remuneration to the partner will be taxable under PGBP. Similarly, any interest income is also PGBP. It is not income from other sources. Generally, your interest income is income from other sources, but interest income from a partnership firm to a partner is PGBP. So that's also needs to be considered. And it is only taxable. It is only taxable to the extent allowed in the firm. So it is only taxable to the extent allowed in the firm. So which means you have provisions whereby for interest, it is only eligible up to what, 12%. Similarly, for remuneration, you have calculation based on your income portion, that is up to 1.5 lakhs and then above 1.5 lakhs what you do. So this calculation needs to be done. So whatever is eligible for the firm as a deduction, that only will be claimed as an income in the hands of the partner. Share of profit is exempt for a simple reason. An income cannot be double taxed. So it is already taxed by the firm. Firm has paid taxes on that profit. So whatever is distributed is not taxable again in the hands of the partner. So that is for a share of with respect to a partner. With respect to HUF, you get whatever share of income you get is exempt. And in case if there is any asset, that is in case of let's say there is they call this as impartable estate, which means it cannot be divided. It cannot be divided. So this whole estate of this HUF will basically be considered as the income of the eldest member, which will be considered as the eldest of the eldest member. So this is one of the rules. So as far as HUF goes, if there is any impartial asset, impartial estate with respect to HUF, then it shall be clubbed in the hands of the eldest member of the HUF. So typically we can say it could be the Karta. So it will be clubbed in the hands of the eldest member. And if there is any income from self-acquired property into joint family property, that is, if any property is actually self-acquired, just converted into a joint family property, that is leaving from HUF. It is taxable as HUF. Now it is leaving away from HUF and it is being distributed to the members. Such income shall be clubbed in the hands of HUF. So that is also there. So these are the two things that is related to HUF. And any other clubbing, that is transfer of income without transfer of asset. We saw this revocable transfer, son's wife, daughter-in-law, and minor's income. So all this will be considered in the hands of the person to whom it needs to be clubbed. We have discussed each of these independently here and there. So whatever it is, we will be seeing it in the while working out the problems. We'll see it in the answers. So this is what is a summary of how do you treat the income of a particular individual. So as I told you, just to keep it, this slide explains you what income needs to be treated in what manner. So if it's an individual, whatever 5x of income, it is taxable. Whatever clubbing is taxable. Apart from that, we discussed about a firm and a HUF. For firm, we are saying whatever income the firm provides to the partner is taxable in PGBP, but in case of share of profit, it is exempt. And whatever remuneration and interest provided is not completely taxable. It is only taxable to the extent that it is allowed as a deduction in the firm's hand. So whatever is allowed only, as I told you, it is 12% in the remuneration calculated in the manner in the provided in the act. So this only is allowed. Similarly, the members HUF, whatever share of income is exempt because it is already taxed in the hands of HUF. But however, two situations, one is impartial estate that needs to be clubbed in the hands of the eldest member. And as far as self-acquired property, any income from self-occupied property which is converted into a joint family property will still be taxable in the hands of the HUF. That is income from self-acquired property into joint family. It needs to be clubbed because it is like clubbing only. You are transferring to an individual member for a reason. The reason could be tax evasion. So club it in the hands of HUF itself. So these are the things that we need to look at before getting into the problem. So now going back to the steps that we are talking about. We said the first step itself is to compute residential status. So the residential status for individuals in HUF is 3 categories, or in fact, I will have to say it is 4 categories. So you have resident, you have non-resident, in resident, you have ordinarily resident, not ordinary resident, right? So you have 3 here. And in Finance Act 2020, there was this new amendment called as deemed resident. So deemed resident is someone who's not ordinary resident, but deemed resident shall always be. So this person shall always be the not ordinary resident, and this deemed resident is only for individuals. So this deemed resident will always be considered as not ordinary resident. You would have already covered it under section 6, which talks about residential status. For everyone else, what did we say? It has only 2, resident, non-resident, be it a company, a firm, LLP, a AOP, a local authority, or even an artificial judicial person. It shall only be resident or non-resident. There is nothing beyond this. So for our examination, that is in our intermediate examination, the most important category of assessee will be the individual. So for this individual, there are four categories of assessee. That is, you have resident, ordinary resident, resident, not ordinary resident, deemed resident, who are also not ordinary resident, and then finally you have non-resident. So these are the heads of income. I'm not going to go into discuss about the basic condition, additional condition, all those things, because that would have been already dealt in extensively. The second step that we are talking about, classification. We said there are 5 heads of income. Each of the heads of income should be identified and grouped. So you identify, as I told you, if it's salary, put it in the bucket of salary. If it is interest income from fixed deposit or something, put it in the bucket of what? Income from other sources. If it is remuneration from partnership firm, categorize it as what? PGBP, profit and gains from business operation. So this is how you categorize. You identify and group them. Then know the charging section. That is, every section will have something called charging section, which is basically the section which tells you that such income is taxable. For example, section 15. Section 15 of salary tells you that a particular income is taxable. A particular income is chargeable to tax under the head salary. Similarly, you have section 45, which says capital gain. A particular income, we say it is chargeable to tax under capital gain. So this section is what will give the power to the income tax department to say that this income is taxable under so and so head. So look into the concept of charging section and accordingly tax it. Also see other provisions which will help you identify the income of that head. So calculate income of each head of the income. So that is how you actually define it. And the third step is computation. So you apply each of these provisions, whatever you know, exclude exempt income, which is categorized under section 10, which is either wholly exempt or partially exempt. Then provide for deductions, which is allowable expenditure, not allowable. This deduction, whatever we are saying, is not chapter 6A. What we are saying here is whatever is allowed. For example, in business or profession, there are various expenditure which says it is allowed. There are various expenditure which is actually not allowed. So categorize accordingly. So provide allowable expenses and disallow expenses which are not allowed under the provisions of the Act. So that is step 3. Step 4 is you club the income. We said, is there any diversion of income? Income without transfer of asset, son's wife minus income, daughter-in-law's income. So all these things needs to be clubbed. So that is step 4. Moving on, you will have to do set off and carry forward. We saw that in detail. What did we see? There are 3 types of set off losses. First is you prefer inter-source, then do inter-head, and finally do carry forward and set off. So we also saw one table which explains the entire loss position of set off losses. So we said if it's an house property, it can be adjusted across the any heads of income. Only thing is it is restricted to how much? It is restricted to 2 lakhs. So the current provision says the loss adjusted in house property under other head is restricted to 2 lakhs. Anything above that needs to be carried forward. So that is what we said. And anything related to profit and gains of profession, if it is speculative loss, it can only be adjusted with speculative income. Similarly, if it is a specified business, that is 35AD business, it can only be adjusted with 35AD business. It can only be adjusted with 35AD business. Other than that, any other business loss can be adjusted with profits from speculative, profits from specified, profits from ordinary business. So all 3 is allowed. Not all 3, that is inter-source. For inter-head also, it is allowed across the division. Only thing which is not allowed is what? Only thing what is not allowed is PGBP. Then you have short-term capital loss, which is only allowed with short-term capital gain, long-term capital gain. Only with short-term capital gain, long-term capital gain. When it's come to long-term capital loss, it is only with long-term capital gain. It is not even inter-source. It is only same long-term capital. It's not even inter-source. And then horse race, only with horse race. So things like your horse race, long-term capital gain, speculative loss, third specified business loss. These four things, even inter-source is not allowed. Even inter-source is not allowed. So when I say this, let's say long-term capital loss, then your speculative 35AD and horse race. So this inter-source is also what? Not allowed. So for these set, inter-source is also not allowed. And when you say inter-head, capital gain cannot be adjusted elsewhere. So capital gain is only adjusted with inter-head. It cannot, within the head, it cannot go outside the head. So that is what capital gain is one of the restrictions which has with respect to this within the head only. So if you have a short-term capital loss, you can adjust with long-term capital gain, but not with anything else. And finally, income from other sources. You hardly will have losses in income from other sources. Even if you have losses, probably it will be only related to horse races. So that's what we discussed in clubbing of income and carry forward loss. Now we will move on to application of rates. We said we need to apply the rates. We'll first understand for individuals what is the rate. For both individuals and HUF, what is the rate. So typically the first slab rate, which is up to 2.5 lakhs, is nil. 2.5 to 5, it is 5%. 5 lakhs to 10 lakhs, it is 20%. 5 lakhs to 10 lakhs, it is 20%. Above 10 lakhs, it is 30%. So there is one, there are some other slabs given for senior citizen and very senior citizen. So who is a senior citizen? A basic limit for resident individual. This is very critical. For non-resident, there is no concept of senior citizen. The senior citizen's concept is only to resident. Both senior citizen and very senior citizen is only for resident. Above 60 years, but less than 80 years is senior citizen. Above 80 years is very senior citizen. There is a circular which says a person born on 1st April of a particular year shall be treated to have completed 60 years or 80 years, whatever it is, on 31st March itself. So typically, a person who was born on 1st April 1962 would have achieved 60 years on 31st March 2022. So this person will be 60 years on 31st March 2022. So they also should be concluded. So person born till 1st April 1962. So you can remember this. You need not calculate 60 years every time. Any person who's born on or before 1st April 1962 will be senior citizen. For very senior citizen, this shall become what? 42. So before 1st April 1942, on or before 1st April 1942, they become very senior citizen. So you need not calculate it every time. Just remember 62, 42. Anyone born before, on or before 1st April 1962 is senior citizen. On or before 1st April 1942 will be very senior citizen for the previous year. For the previous year, 2021-22. So this is how you remember this. Okay, moving on. We said when you're applying rates, you also have to see about surcharge. You also have to include health and education cess. Health and education cess is fixed. It is how much? It is 4%, right? So it is 4%. So that is fixed. So what about surcharge? Up to 50 lakhs, it is nil. 50 lakhs to 1 crore, it is 10%. 1 crore to 2 crore, it is 15. 2 crores to 5 crore, it is 25. Above 5 crores, it is 37%. Now, when you're understanding the surcharge, we need to understand that there is a limit on surcharge in certain levels. So what income such as your dividend income, short-term capital gain under section 111A, long-term capital gain under section 112A. So for these income, the limit is 15%. So the maximum surcharge which can be applied is only 15%. So generally, when you say this incomes, short-term capital gain is itself taxed only at 15%, correct? Short-term capital gain under section 111A itself is taxed only at 15%. So when you're having a surcharge above 15%, that is when you're having a surcharge at 25 or 37, which means it is greater than, surcharge is greater than tax, correct? Tax rate, surcharge is greater than tax rate, which is not ideally right. So they're restricting to 15%. Similarly, for long-term capital gain, it is 10%. So here also they are saying restricted to 15%. So though though it is slightly higher than the income tax, but they're slightly restricting it. So they're restricting the surcharge to 15% for these three incomes. What incomes? Your dividend income, your short-term capital gain, and your long-term capital gain under section 112A. So for these three sections, it is limited. And it does not talk about short-term capital gain under section 111. That is whatever long-term capital under section 112. So whatever 112 is LTCG taxable at 20%, right? So that is, there's no restriction on that. There also it goes beyond tax rate, but it's okay. What they're saying is whatever it is, the benefit is only given to these three income. That is dividend income, your short-term capital gain under section 111A, and long-term capital gain under section 112A. With respect to this Finance Act 2020, there is this new rate introduced under section 115 BAC. So we need to understand what exactly is this 115 BAC. BAC gives you a slab for every 2.5 lakhs. You need not remember it at all. It is very simple. For every 2.5 lakhs, every 2.5 lakhs, there is a 5% increase. Okay, every 2.5 lakhs, there is a 5% increase. So first to 2.5 is 0. Next to 2.5 is 5. Next to 2.5 is 10, 15, 20, 25, 30. Above that is 30. So 30 is the maximum rate. So see the difference between each of this section. It is always 5%. See the difference between each of this range. It is always what? 2.5 lakhs, correct? So only above 15 lakhs, they are bringing it to 30%. So it is 0, 5, 10, 15, 20, 25, 30. 2.5, 5, 7.5, 10, 12.5, 15, 15 and above. Clear? There is no confusion in understanding the slab. It is similarly in a regular rate, it is 2.5, 5, 10. It is 2x. It is 2x. See the multiply of the regular slab rate. For regular slab rate, it is first to 2.5, then 5, 2.5 to 5, then 5 to 10. So you are multiplying. It becomes 5 lakhs after that. Then it is about 10. So that is what it is. So 2.5, 5 is double, 5 to 10 is double. So that's how you do it in the regular slab rate. But in new slab rate, for every 2.5, it is 5%. And the tax rate, it starts from 5, then 20, then 30. Here it is 5, 10, 15, 20, 25, and 30. Clear? Okay. Now, this benefit, this optional rate, as the word says, it is optional. It is optional. But to claim this optional rate, there are certain things probably you need to forego. Or you should not claim. You are not available. Certain exemptions or deductions are not available to you. What are those? Leave travel concession and HRA benefit. So both this leave travel concession, which is 2 years and 4 year a block, is not allowed. Your HRA, whatever is discussed in section 10, clause 13A, is not allowed. So you cannot claim HRA or LTC. Special allowance for office duties is not allowed. Daily allowance to MPs, MLAs is not allowed. Exemption of minor child, that is 1,500 per annum per kid, is not allowed. Standard deduction under section 16 is also not allowed. So 50,000 is also not allowed. Interest on self-occupied property. Interest on self-occupied property is not allowed. So that is the 2 lakhs. 2 lakh is not allowed. Depreciation in your profit and gains or business or profession, there are 2 types of depreciation. One is your regular depreciation, whatever you provide. Then for certain plant and machinery, you have additional depreciation of 15%. So that additional depreciation is not allowed. So this additional depreciation of 15% on newly acquired plant and machinery is not allowed. Then you have scientific research under section 35 is not allowed. It's not allowed as an deduction. Investment linked tax incentives for specified business, that is 35 AD. 35 AD is not allowed. Expenditure on eligible agriculture project, that is 35 CCA, if I'm right, I guess. So eligible agriculture product. Expenditure on family pension. Family pension is also not allowed. I guess it is comes under 36. Then Chapter 6A deductions, that is any deductions from 80C to 80U, nothing is allowed but for two. What is allowed? 80CCD2. 80CCD2 alone is allowed, and then 80JJAA. So these are the only two which is allowed. So these are the only two which are allowed. So this is the things that you need to forego. Similarly, carry forward or depreciation specified above, that is depreciation on additional depreciation. So if you have any depreciation on for provided as additional depreciation, losses relating to that cannot be carried forward. So you need to forego that portion of loss. Similarly, income from house property, other heads. So you cannot adjust the income from house property. That is, when you have a loss carried forward, you can only adjust it with other heads of income. You cannot adjust it with other heads of income. So these are the things that you need to forego. Let me repeat: you are not eligible for leave travel concession, house rent allowance, special allowance, MP MLA allowance, standard deductions, exemption of minor children. Then relating to property, you are not eligible for self-occupied property. With respect to business, you are not eligible for additional depreciation. You are not eligible for scientific research. You are not eligible for agriculture project. You are not eligible for family pension expenditure. So all this is not allowed. Then you are also not eligible for Chapter 6A deduction. So remember it headwise. What are the things that are not allowed in salary? What is not allowed in house property? What is not allowed in this is actually 56. Okay. What is not allowed in business or profession? What is not allowed in income from other sources? What is not allowed in Chapter 6A? So remember head-wise, category-wise, and know what are all you are not allowed. And with respect to losses, if it is anything related to this additional depreciation loss, that cannot be carried forward. And with respect to house property, it can only be adjusted. It cannot be adjusted with other heads. So these are the things that we need to forego. After foregoing all this, in case if you have what you call a beneficial, thing, that is if you have lower taxes, then you can opt this. But when you're opting this, one thing that we need to remember is this option is every year. Let's say for previous year 21-22, I'm okay. I need 115 BAC. For previous year 22-23, I no need 115 BAC. This is perfectly fine for any assessment. So I can pick every year, but this every year option is restricted, is not available for persons having business income. So for the persons having business income, once exercised shall apply to subsequent years also. So it shall apply to subsequent also. Once withdrawn, it shall never be opt till the business continues. So as long as the business continues, they cannot decide, they cannot use this 115 BAC again. So it is only once they have exercised, they'll have to adopt it forever. If they're opting out, that is, if they're withdrawing in one particular year, then for the rest of the period of the business, they cannot opt to this provision again. So remember this alone, whatever it is, with respect to this provision, as we said, if they're having business income, it is one-time option. Once they have opted, they cannot come out. If they're coming out, in case if they're withdrawing, then they can again choose 115 BAC. With respect to TDS, now if I'm coming under 115 BAC, I'll have to report it to my employer. Saying that, see, this is my new rate, please go by that. So don't deduct in the regular rate, deduct tax in accordance with 115 BAC. So that is what 115 BAC is all about. Okay. So any doubts in this? I'll just attend some of the questions till this 115 BAC. Yeah. They can opt either for normal tax or 115 BAC. As I told you, it is optional. They are free to opt whichever they want. But once they opted, in case of business income alone, once they have opted, they'll have to follow it regularly. When they are actually withdrawing, they cannot again choose that again. So that's the only thing that needs to be considered. And in case if the year in which they have opted, if there is any error in application, if there is any mistake on application of 115 BAC, the income tax department shall cancel 115 BAC and provide you the regular portion itself. So the income tax office will analyze your return and say whether you are actually eligible for 115 BAC, whether you have applied 115 BAC appropriately. If not, they will cancel your 115 BAC, which means they'll treat it under normal norms. So that's what it is about. So next is we'll discuss about this concept of marginal relief. So you're eligible for rebate, so you can also claim this marginal relief. So we'll see both of this. What exactly is marginal relief? It is basically increase in tax, including surcharge, is greater than the increase in total income. Before understanding this, the small box, the text in the small box, we'll see the steps, we'll see a problem, that is, we'll see a number, and then if you're still confused, probably we'll come back to that little box. The first thing is, we'll have to calculate tax for total income under normal rates. Calculate tax for total income under normal rates. So whatever is the regular rate that we need to calculate it. Then calculate for base limit. So let's say your income is 51 lakhs. Your base limit becomes 50 lakhs because still 50 lakhs there is no surcharge, right? So if your income is 51 lakhs, you calculate tax for 50 lakhs. If your income is 1 crore 1 lakh, you calculate it for 1 crore. So the previous base limit. So just the previous base limit. So you take the just before whatever was the base limit, you take that base limit before total income. Now you calculate excess tax, that is, you do 1 minus 2. So you do a simple mathematics of 1 minus 2. Now you calculate excess income. What is excess income? The total income minus the base limit. Total income minus the base limit. That is income used in one, income used in 1, income used in 2. So that is what is called income in 1 minus income in 2. So that will give you excess income, right? In our example, we are talking about 51 lakhs. So 51 minus 50 lakh is 1 lakh. So that is what then. So the margin relief will be 3 minus 4. So whatever is, if it is positive, okay, if it is greater than 0, that can be claimed as your margin relief. We'll see this in a small answer, so as a thing. So let's say income is 51 lakhs. So what is the first step? What is the step 1? Calculate the actual tax, whatever it is. So you calculate tax. So let's assume he's a normal person, not a senior citizen and all. So up to 10 lakhs, it is 1,12,500. So it will be what? 1,12,500 plus 41 lakhs into 30%. So what will be there? 12,30,000, right? Just stop me if I'm wrong. Like this, just correct me if I'm wrong. I'm just doing it as it is. So it is 12 lakhs plus 30,000. 12 lakh 30,000. So 1342,500. Now you have surcharge at 10%, right? So once it crosses 50 lakhs, you'll have to have 10%. So it will be 10% on this, 10% on tax. So it will be 134,250, correct? So 1,34,250. So your income will be 14,76,750, right? So your total tax. You can stop here. You need not calculate education cess. So because it is same, it is across in both cases. It is going to be only 4%. So now we are going to see step 2. So what is step 2? Tax is 1,12,500, right? It is 1,12,500 plus. Now what you do? You only calculate it for how much? 50 lakhs. So 1,12,500 plus 40 lakh into 30%. Now what will be there? It will be 12 lakhs, 13,12,500. Surcharge is how much? Nil, right? So it is nil. So your total tax is 13,12,500. 13,12,500. Now, just see in this level itself, just see how much is surcharge. 1,34,250. But if you have earned 1 lakh lesser, it would have been nil. Correct? So that's what we are computing. So this is greater than 1 lakh. How did you get this 1 lakh? It is 51 lakh minus 50 lakhs. So your surcharge is greater than the excess income. Now, for a moment, I'll go back to the slide and understand now. Increase in tax is greater than increase in total income. So your surcharge portion is greater than that additional income that you have earned itself. So now we have calculated till step 3. Okay, now we'll go back and understand step 4. So what is step 3? Sorry, step 3 is called excess income. So what is excess income here? It is 1 lakh. That is 51 lakhs minus 50 lakhs. So this only gives you this 1 lakh. So now step 4 is what you calculate marginal relief. So margin relief is nothing but you calculate the excess. So what will it be? It will be 1,34,250 minus 1 lakh. So that will be 34,250. So you reduce this before calculating the cess itself. So your surcharge will be reduced by 34,250. So your margin relief is 34,250. Your surcharge is 1,34,250. So the actual surcharge becomes 1 lakh. So in this case, what you will do is you will actually calculate your total tax, right? Your total tax will be how much? 1476,750 after surcharge, including surcharge. You less marginal relief of 34,250. So you get it as what? 14,42,500, right? 14,42,500. If I'm right, yeah. So this 14,42,500 becomes your actual tax. Now you add cess on that. Cess at 4% to get the tax payable. Clear? So this is margin relief. Now go back to this. Understand this concept. Increase in tax, including surcharge, is greater than the total income. The 1,34,250 of surcharge is greater than the total income. So that's why you calculate excess tax and excess income. The difference, if it is positive, you treat it as there. Okay. So next is resident rebate for under section 87A. Rebate under section 87A, it is available only to resident individual where the total income is lesser than equal to 5 lakhs. So what is the rebate? Whatever is the income tax payable, including before, that is before the education cess and other things, or 12,500. So you calculate if your income is, let's say, 4 lakhs, what will be it is? It is 1,50,000 into 5%. That will be 7,500. The 7,500 is eligible as rebate. But moment you cross your income above 5 lakhs, let's say you have 5,10,000 or even 5,01 rupee, the provision is not at all applicable. You'll have to pay the tax on the whole rupees. So that's what it is about. And it is not available in respect of long-term capital gain under section 112A. So it is not eligible for long-term capital gain under section 112A. So that is about your marginal relief and other things. So now we have understood the regular rate. We have understood the 115 BAC rate. Finally, we will understand the last concept called as alternate minimum tax. This is called as a concessional rate. So we need this is an alternate tax where the government says you must at least pay this tax amount. You must at least pay this tax amount. So what is its purpose? What is the purpose? Now, when a particular assessee has deduction under 10AA, 35AD, or Chapter 6A, Heading C. So what is Heading C? Heading C is whatever is applicable to intermediate is only 3 sections, right? 80 JJAA, 80 QQB, 80 RRB. So for intermediate, these are the only 3 sections. So this 3 plus 35 AD, if you have any deductions under these sections, then government says, see, I need regular tax flow. We spoke about why TDS advanced tax and all is there. So government says, see, I need tax flow. Just because you are having a deduction, and if you are not paying taxes only because of that, I'll have a provision whereby you say, I request you to pay a minimum tax. So chapter 12BA was introduced, the concept of alternate minimum tax. It is for other than companies. It is not for companies. It is other than companies. See, this alternate minimum tax is very important. Please understand this concept. And it is also not applicable for a person with an adjusted gross total income less than or equal to 20 lakhs. So when you're working out a problem, you need to see two things. When you're working out a problem, you need to see two things. First is whether there are any deduction under 10AA, 35AD, 80QQB, 80RRB, 80JJA. If no, then there is no what 115. There is no 115. I'll just specify the concept itself. There is no alternate minimum tax. Okay, there is no alternate minimum tax. Now the second one is the total income. The total income is less than or equal to 20 lakhs. Then also no alternate minimum tax. So in both scenario, so when you're answering a problem, it is not coming. So if it is less than or equal to 20 lakhs, it is not applicable. If there is no deduction, also not applicable, of course. So if either of this, if both are satisfied, then you will have to check for alternate minimum tax also. So this alternate minimum tax is discussed under chapter 12BA, and it provides for a flat 18.5% on adjusted total income. So you calculate adjusted total income. What is adjusted total income? Before giving these deductions, the 10AA, 35AD, the heading C of chapter 6A, before giving that, whatever is your adjusted total income, on that you calculate flat 18.5%. There is no slab rate. You say 18.5% and compare. Now this provision is not applicable on 115 BAC. So if someone has opted 115 BAC, this provision is actually not applicable at all. So they need not calculate if they are falling under 115 BAC. And what is adjusted total income? It is nothing but total income plus 10AA plus 35AD plus 18C. The three sections that whatever is applicable for intermediate, we need to add if there is anything from that. So that is the thing. Next, the provision says whatever you are paying extra can be taken as credit up to 15 assessment year. Now let's take the small example. Let's say my regular tax is 10 lakhs. Okay, my regular tax is 10 lakhs. My alternate minimum tax is 12,50,000. Okay, 12,50,000. Now income tax says take credit for the 2,50,000. That is the excess tax. So calculate that and take credit for 15 assessment years. So take credit for 15 assessment years. So you can carry forward up to 15 assessment years, irrespective of whether you are paying under alternate minimum tax, irrespective of whether you have that heading C income or chapter 10, irrespective of that, you can carry forward it. Now, let's say this is what? Assessment year 22, 23. Now in 25, let's say 24, 25 itself, my regular tax is 15 lakhs. Okay. My alternate minimum tax is 12 lakhs. Okay. Now I'm going to pay tax under regular slab because this is only higher. When I'm paying this 15 lakhs, government says use this credit. So your tax will become 15 lakhs minus 2,50,000. So I'll only be end up paying 12,50,000. I'll only end up paying 12,50,000 because I'm utilizing this credit. Okay. This credit is what I'll take it up as adjustment in the year in which I'm paying tax under normal circumstances. So that's what the provision says. AMT minus regular income tax. That is, in our case, it was 12,50,000 minus 10 lakhs, right? In our case, it was 12.5 minus 10 was the credit. Now it can be carried forward to 15 assessment years. It is allowed even if you have no income under this section, even if your adjusted gross total is less than or 20 lakhs. So whatever it is, you can carry forward. Same way, when you're talking about this alternate minimum tax, all other provisions such as your advance tax and belated filing applies. So whatever interest we are talking about under 234 ABC applies for this alternate minimum tax also. So this is alternate minimum tax. I'll see if there are any questions that I can answer till now. Yeah, so basically, Sandeep, so it's basically business income in under 115 BAC. The question is whether what is the exact provision? If you are having business income under section 115 BAC, you do not have once you have chosen, you will have to follow that continuously. If you are withdrawing, you cannot follow it again till the business exists. Yeah, Gajar, for individual opted this year, they can of course opt out next year, again opt in. So for individual, there's no restriction who does not have business income. In fact, it is only for individuals, the 115 BAC itself. So typically, other than one who are having business income can choose in 1 year, can withdraw in another year. Opt in, opt out, as they wish, as they want. So that's what with respect to for individuals not having business income. The deduction under 35 is allowed to be carried forward. As I told you, whatever, probably we'll keep it this way. Earlier, 35 had weighted deductions, which means your expenditure is 100, you're allowed to claim 125 or 150. So that is where the confusion came. Currently, the provision is only 100%, so there is nothing to worry about. So as far as the section 35 goes, whatever needs to be carried forward, if there is any carry forward loss, it is not allowed. So we'll put it this manner. In 115 BAC, it is not only depreciation, any carry forward loss. So any carry forward loss on exemption or deduction not allowed for 115 BAC is withdrawn, which means you cannot anymore claim it. So it's taken away. So you cannot claim any losses. You cannot carry forward any losses on relating to the losses because of the exemption deduction not allowed under section 115C. What are they? You have, let's say you have depreciation because of additional depreciation. You have scientific research under section 35. So if there are these losses, then you are not allowed to carry forward. So losses relating to the exception or deduction not allowed cannot be carried forward. So that's as simple as it is. Correct. Yeah, Pandava. So whatever 115 BAC, whatever we have adopted, we should not take that exemption. So whatever exemption deduction which is specified there cannot be allowed in your computation of total income. We'll see that when you're actually solving problem. As we said, even standard deduction. So when you're computing salary, you should not provide standard deduction. So that's what it is, Gayatri. BAC, whether marginal relief is available? Yes, margin relief is available under 115 BAC also. Because the surcharge, margin relief is for the reasons of surcharge. So surcharge remains for your regular income also. Just that you'll have to be very careful when you're choosing that base limit. So in both the situations, regular tax rate or normal tax rate, you'll have to be very careful in the base limit. So if you're calculating for an income more than 1 crore, your base limit becomes 1 crore. If you are calculating for above 50 lakhs, your base limit is 50 lakhs. Take the level just before the original the tax limit. So that's what it is there. When AMT credit is taken and after credit, tax payable below AMT of that year will be AMT restricted. So as we saw in our example, the next year your AMT is lesser. Your next year the AMT is lesser. So you pay under normal tax, but you take credit. So that's where the concept where you're actually having lesser AMT when you are paid under AMT in the earlier year, that credit can be adjusted. So that's what it is there. Your question actually is actually a good question. Probably I'll explain that here. What if, let's say this is 13 lakhs, okay? If it is 13 lakhs, let's say this is actually 13 lakhs. In this case, credit is restricted. Credit is restricted to 2 lakhs. Okay? So this is important because after giving credit, your tax cannot be lesser than AMT. So after giving credit, your tax cannot be less than AMT. So as given here, if after providing that credit, if it goes before AMT, restricted to AMT. So you can only utilize 2 lakhs of credit and not 2.5 lakhs. Because if you use 2.5, it goes below AMT. That is not allowed. So that's the answer for Parth Shah's question. (15 minus 3). No. See, the 3 lakh is the difference that we are talking between 15 and 12, right? So that's not whatever is allowed is only whatever credit you have. The credit you have is only 2.5 lakhs. The credit what you have is only 2.5 lakhs. So you're adjusting your credit. It's limited to whatever credit you have. So though the difference is actually 3 lakhs, you can only adjust 2.5 lakhs because that's the credit you have. So you cannot go above the credit. So why we are deducting 2.5 lakhs? Because that is the maximum credit we have under our account. Yeah, tax credit is carried forward for 15 assessment years from the immediately next year onwards. Whether profession can opt. When I say business, probably I'll stress that when I say business, it typically includes profession also. So when you say the head, profit and gains of business or profession, it's not business alone. It is income from profit and gains or business or profession. So it's typically PGBP. Continuous loss, MAT credit charge. See, if you have loss under income tax provisions, but profit under alternate minimum tax, only then alternate minimum tax will probably come. Otherwise, if it is loss under both your alternate minimum tax, that is your adjusted gross total income is also negative, your gross total income is also negative, then probably you don't do it. Ashish, yeah. So as I told you, it will get restricted. The tax credit adjusted in AMT can be restricted only to the extent of the AMT itself. It cannot go below AMT. So your adjustment, if it is 13 lakhs, will get restricted to 2 lakhs. So that's what it is. I guess I've answered the question of why we actually reduced 2.5 lakhs, because it is 2.5 lakhs here. That is why I've just drawn an arrow here to say that this is what the 2.5 lakhs is, because you have the credit. In the earlier year, you had a credit of 2.5 lakhs. So you're you're adjusting only 2.5 lakhs. But now, if the difference itself is more than 2.5 lakhs, you restrict it to whatever amount. That is, it cannot go below the alternate minimum tax. Okay, I'll probably explain. Some of you wanted to understand this 3 lakh again, the credit alone. So probably I'll put another example. I'll repeat this example itself. So in assessment year 22-23, your tax under normal rate is 13 lakhs. Okay, your AMT is 11 lakhs. is, sorry, 15 lakhs. Your AMT is 15 lakhs. So now you pay tax per AMT and take credit. Take credit of 2 lakhs. Okay. This credit can be carried forward to 15 assessment years. So clear? So that is there. Now, in assessment year 23-24, I have regular tax of 16 lakhs and AMT of 14 lakh, AMT of 14 lakh 50,000. Now I can utilize the credit available here. So my paid tax will be 16 lakhs minus AMT credit. I can only adjust credit to the maximum of this difference. So this is current year difference, right? Current year difference. Credit available is 2 lakhs. Whichever is lower is only I can adjust. I cannot go beyond this. So I can only adjust how much? 1,50,000. So now I will pay 14,50,000. So my credit carried forward will be how much? 50,000. That is nothing but 2 lakh minus 1,50,000. That is utilized. So this is how I'll have to take it. So this is what will be carried forward. So with that, next year you will carry forward 50,000. So whenever required, you will do. But in case, if let's say this itself is, so this is how it works. In case if this is more than that is, I guess I've explained in one itself. So probably that is how it works. So that's the answer for your thing. Alternate minimum tax. Now, how do you calculate alternate minimum tax? Let's say your total income is 52 lakhs, okay? Or let's say 32 lakhs. You have 80 JJAA, okay? 80 JJAA. You have for around 10 lakhs. Okay, so 80 JJ you have provided for 10 lakhs. So your adjusted gross total income will be 42 lakhs. Okay, 42 lakhs. So it says into 18.5%. So this regular rates. Now, whichever is higher becomes the tax. So you calculate regular tax rate on 32 lakhs. How much it will be? If you are calculating regular thing on 32 lakhs, for first 10 lakhs, it is 1,12,500 plus 22 lakhs into 22 into 30%, right? So it will be 6,60,000. So it will be 772,500. So this is your regular tax rate. As far as this goes, how much it will be? 4,20,000. I'll have to use calculator for this. I'll just give me a moment. So it is 4,20,000 into 18.5%. So it is 42 lakhs, right? So 4,20,000 into 18.5%. So it is 7,77,000. Now I'll just write it a little legibly than generally I could. 7,77,000, right? So this is your AMT. And this is your regular tax. Now your AMT is greater than your regular tax, correct? Or no? Yeah, correct. So it is higher, correct? So it is higher. Now I will pay tax pay tax on AMT. So I'll be paying how much? 7,77,000. Take credit. How much credit I'll take? 770 minus thing. That is what? 4,500, right? So 4,500 will be a credit which I can utilize it in the next year. So now I hope regular tax is 1072. Is it? How is that? No, regular tax is only on 32 lakhs because that is your net total income. In net total income, you are saying it is after considering 80GJAA. So I am calculating for 32 lakhs, which is 7,72,500. For adjusted gross total income, it is 18.5%. That is 7,77,000. Hope the numbers are right. So that's how this works. So I guess now we have understood the alternate minimum tax also. So that's how this works. So this alternate minimum tax. Now we'll see some problems to understand the thing, that is your how you actually compute in the examinations. So we'll start with problems. Of course, these are all your material income tax material problems only, your steady material problems only. So we'll basically start with this problem. After this problem, probably we'll take a break. So probably it'll extend beyond 8:15. So I'll just solve this problem alone. So we'll just go through the problem. Just see how this actually works. Okay. So how this actually works. So I will tell you how you'll have to go about this problem. So first you are understanding. So first you are saying that it is. So first is Purvi is aged 55 years. So as I told you, you need to see whether a particular information is additional information or unnecessary information. That is confusing information. 55 years is irrelevant because you need to know whether the person is a senior citizen or not. She is a chartered accountant in practice. Relevant or not? Probably if you are applying 44 ADA, where books are not maintained, this is relevant. Otherwise, it is not relevant. She maintains her accounts on cash basis. So when you say cash basis, what is important? There are two types of accounting: mercantile accounting and cash system accounting. When you say mercantile accounting, it is accrual. You will have to book expenditure even if you have actually not paid, but it's still already due, right? It's cash basis. You only book whatever you have paid. So that is cash basis. Her income of expenditure for 22 reads as follows. I'll first read the income and then come to expenditure. So she has audit income, taxation services, consultancy. So these are the incomes that she has earned. She has received dividend. Okay. Now, before getting into this problem, I'll probably tell you one more. For every problem, you'll have to do 4 steps. Okay, 4 steps to calculate. 4 steps to calculate total income. Rather than total income, I would call it what? PGBP. 4 steps for PGBP. So what is that? You first take net profit. Net profit before tax. So that is your profit before tax. So you can call it as PBT or net profit. So now you take this. You add, okay, you add expenditure disallowed. Expenditure disallowed. Okay. So you take this. Then you add income considered but not accounted or something. Okay, but not accounted. So that is also included. So these are 2 additions. Next, you will have to do 2 reduction. Less income considered under other heads. That is, I'm excluding all business income. That is everything other than the business income. Like if there's an income related to house property, I remove. If it's related to income from other sources, I remove. If it's related to capital gain, I remove. Of course, you will not have salary. Or in case of salary also there, you remove that also. So income considered under other heads has to be removed. Okay. Then less expenditure allowed but not accounted. So typically there is something which is not accounted, but I still need to give that as an expenditure. That is there. So this only will be your profit and gains from business or profession. I'm sure none of you would have seen bad handwriting as bad as this, but I'm really sorry. I don't have an option because that's how I generally write. So typically hope you have some understanding of what exactly I've written. So basically the 4 steps is step 1, add expenditure disallowed. Step 2 is allow incomes, which is not considered. Step 3 is less income that is considered other heads. Step 4 is expenditure allowed but not accounted. So with this only you get your profit or loss, which is profit and gains from business or profession. So this is how you do. So when you're reading a problem, you need to see which of these 4 steps that particular head will come under. So that's what we are going to see. Okay. So now we are talking about dividend received. So dividend received is taxable under income from other sources. It is not taxable under business or profession. So when you're doing an income for business or profession, what you need to do is you need to exclude it from the business or profession, which means you need to less. It comes under step 2. Okay. So you need to less. So I'm just putting a small mark in my question paper as minus, saying that I'll have to reduce it from my business or profession. And then I also say I need to add, reduce from business or profession. Another is add to income from other sources. Income from UTI gross. So this is also an income from other sources. Minus plus. When I just saying this, there are words like gross, right? So what do you mean by gross is it is before tax deduction. Before tax deduction. In case if the sum uses net, then you will have to know the TDS rate backward and then identify it. Okay. For example, we'll say, I'll try to explain when the word net comes. Let's say your rent, okay? Calculating. The net is what you are actually, net is not your income, right? Gross only is your income. So you'll have to identify gross. How do you identify gross? So you take, let's say generally what happens in rent, 100 is rent, you deduct 10, you give 90. Now I'll teach you a small cross multiplication which you would have learned in school. Now we know what this 90 is. We need to identify this 100, correct? We need to identify this 100. So the cross multiplication says 4,95,000. This is cross multiplication, right? 4,95,000 divided by 90 into 100. So if 4,95,000 is equal to 90, what is it for 100? So how do you compute? Of course, I'll have to use calculator. So divided by 90 into 100. So it becomes 5,50,000. So this becomes my gross income. This is similar to the gross up concept we studied in TDS. We studied a concept called gross up in TDS. This is how you work actually. So when your exam provides the word gross, just take it. The exam uses the word net, then you are supposed to gross up. You are supposed to gross up in the manner I showed you. Then honorarium received from various institutions for valuation of answer paper. Again, this is actually not your business income. So you can reduce it and you can add it in income from other sources. Rent receipt from flat let out. Rent receipt from flat let out will be, again, you'll have to reduce it. You'll have to remove it from business or profession and you'll have to add it as income from house property. Okay, these are all the things related to your whatever is that you are talking about income. This is the side of income that you are talking about. Now we need to talk about expenditure. Expenditures, what are the things that are covered here? So it is typically salary to staff. What do you mean by salary to staff? It is typically 15 lakh 50,000. So what is 15 lakh 50,000? It is your salary that has been paid. Stipend to articles 1 lakh 37,000. Incentive to article assistant 13,000. Office rent 12 lakh 24,000. Printing and all these are allowed, which is already provided in P&L, so you need not do anything. Meeting, seminar and conference, repair, maintenance and petrol of car, purchase of car. What does the question say? It says purchase of car, which is what expenditure? It is capital expenditure. So this is not allowed. But of course, depreciation on this is allowed. So probably we can say that you will have to allow depreciation on this. Traveling expenses. Traveling expenses, again, it is allowed. Municipal tax paid to house property. It belongs to income from house property, not relating to your business or profession. So you need to add this. Correct? You need to add this. Now we'll have to come for this other information, which is what is critical. So other information will typically tell you situations which are whether unnecessary or it is relevant for you. That is in the extra information to your problem. Now, allowable rate of depreciation of motor car is 15%. So, of course, we have a motor car, we can provide it for that. Value of benefits received from clients during the course. Now, benefits is 10,500. Thus, now the question comes whether whatever your income should only be in cash or can also be in kind. As far as your business or profession and all, it can also be in kind. So the value of whatever market value of that kind will be treated as your income. So this 10,500, it says it's not included in P&L. So what do? You'll have to include it as an income. So step 2, you'll have to add step 4, right? Step 3 in what we discussed here. So you need to consider income, right? Now you're going to do step 2, which is you're going to add this as an income. So you are going to put a plus mark to say that you are going to add this income. Incentives to article assistant represent amount paid to 2 article assistant for passing IPCC. So whether this is allowed or not, it is actually allowed. So you'll have to only write a note. So what you can do is you can say N. So I'll have to write a note for this. Repair and maintenance includes car 2000, which is basically for the period October 21 to September 2022. Now the question comes whether this is allowed or not allowed, because it includes period outside the previous year. So we need to see whether this needs to be included or not. So for this, what is important is the first thing that we saw. What did we see? It is done in cash basis. So moment it is cash, it doesn't matter for what period you're doing. If you have spent, you take it. So for this also, we only give a note. Nothing else to be done. Salary includes 30,000. Salary include 30,000 to a computer specialist in cash for assisting Ms. Purvi in one professional assignment. So typically cash paid more than 10,000 is not an allowed expenditure. So you need to put a plus here. So you also go and say for salary is what you're doing that plus. So there is an addition in salary. Then traveling expense include on foreign tour, which is within RBI norms. So there is nothing to do about it. So you are allowed to spend this. So probably you can write a note alone. Medical insurance premium on health of dependent brother, major son dependent honor amounts. So medical insurance premium 80D, we need to see how is this paid in cash. So they have said paid in cash, they have said son dependent honor and brother dependent honor. So we'll have to see for what it is eligible, and we'll have to understand whether cash is allowed or not. So however, we can say that it is an 80D which has to be considered. So I'll put D here. So that is for 80D. She invested an amount of 10,000 in national savings certificate, that is C. She has paid 70,000 towards, that is for your tax calculations only. So I'll just leave it as it is. So this is the problem. Now we need to solve this only. So we'll proceed with solving the problem. So what you do, you'll have to actually compute whatever it is about. So just give me a second. Yeah. So now we'll go ahead and solve question number 3. Okay. So we'll solve question number 3. So we'll have to do what? We'll have to have, I'll start with the heading itself. So you'll have to say computation of total income of Miss Purvi for assessment year 2022-23, right? So now I have particulars, then I'll have amount column, I'll have another amount column, just for understanding. I'll have note reference, okay? So these will be my relevant columns. So with this, probably what I will do is, I'll first start with the computation. So you'll have to go head by head. So we'll have to see what are all the heads covered. You have what? You have house property, you have business or profession, you have income from other sources. So these are the 3 heads that you have. So we'll have to start with income from house property. You can either work out under itself or put a separate note, and there you can calculate income from house property. So you can do either way. What we'll do is we'll first try this method with the heads here and working the separate note. So I'll put note 1. Then I have income from this profession. Income from profession, I'll say 2. Then you have income from other sources, you'll have 3. Then you say that will be your what? Gross total income. So that will be your 4. Sorry, there is no notes. There's no note for it, right? So less deduction under chapter 6A. So this will be 4. So with that, I get my net total income, correct? So this will be my net total income, right? So I compute. Now I'll have to compute each head. So I start with 1. Income from house property. So what is it? Again, I'll have to say particulars. We can have 1 or 2 amount columns and then a note column. So first thing is, we'll have to see how much income you have actually received. So the rental income is 85,600. So 85,600 is there. So we'll have to take it as gross annual value. Gross annual value is 85,600 less municipal tax that is paid is 3,000. So you take that 3,000. So that is 82,600. This is your what? Net annual value. In this you less standard deduction under section 24A. So at what? 30%. So on 82,600, you compute 32%. So how much will it be? 82,600 into 30%. So that is 24,780. So your income from house property will be how much? It will be 920. So 81, 11, 7. So will be what? 57,920. So 57,920 will be your income from house property. Go here, write this as 57,920. Now we'll have to come and calculate what? Your business or profession. So you go to number 2. Income from business. Again you go particulars. Here you need 2 amount columns because we spoke about 4 steps. So we need to have 2 amount columns. Okay. Okay, so first thing is you take the net profit, whatever is provided in the books. So what is it provided in the books? It is provided as 928,224. So you take 928,224. So now step one, what is the step 1? Add expenses not allowable. Okay. So now you'll have to come back to your question and see what are the expenses that are not allowed. You have salary, then you have purchase of car, then you have municipal tax. So you have 3 expenses that are actually not allowed. So now you work out these 3 examples, 3 expenses. The first one is salary paid in cash. In fact, it's not even salary because she has only paid to someone assisting, but still as far as we are concerned, moment it is cash, it is not allowed. So 40A3, if the preferred way is write the section. So salary paid in cash under section 40A3 because the provision says 10,000. So write the amount. So how much she said? She said 30,000. So now you pay 30,000. Put that you have actually completed this. So put that you have actually completed this. So now you take 30,000. Put in the inner column so that you can add step 1. Then you have what? We said purchase of motor car. Okay, so what was that? 80,000, right? Yeah. So now you have removed the add. That is 80,000. Another minus we had put there is for depreciation. And then the third one was municipal tax. That was 3,000. So go there. You have included it. But so now this is also considered. So this is your total thing. That is 1,10,000, 1,13,000. So your total will be 10,41,224, right? 10,41,224. The next is step 2. Step 2 is less. We said income considered. There is only one income that needs to be considered. That is this value of benefits. So the value of benefits from client. Value of benefits in kind. That is 10,500. So it becomes 1051,724, right? So that's what it is. Now, next is add. Add what? Add. So we have, sorry, this is add, right? So we have done two additions. Now we'll have to go to reductions. Less. So we'll have to do expense considered. Okay. So expense basically considered. So as far as the expense considered is concerned, we add depreciation as one thing. That is, we said depreciation needs to be provided from that allowable rate of depreciation is motor car, because depreciation needs to be provided. Now, when you talk about depreciation, the question comes whether it was for the whole year or half the year. So we need to decide whether it's going to be for the full year or half the year. So we'll consider as full year. It is up to us. We can write an assumption and say that it was considered as depreciation of half year. For all this, whichever thing you need to write something as a note or something, you can typically add it up as 1 year. So let's assume for depreciation, now we need to provide this working a note. So we'll say 1A, sorry, 2A. This is second note, in that you're writing a A. So what is 2A? Depreciation at 15% on 80,000. So it is 8,000 plus 4,000. So that becomes 12,000. There is nothing else, then you need to less. So it becomes what? 1039. 774. Then less income considered separately. Considered separately. So for that, we'll have to write what are all the income that you have. Now you come to income part. So you take first dividend, income from UTA, honorarium. Dividend, interest, honorarium, and then you have rent income. So for dividend, it is how much? 10,524, 7,600. So it is 10,524, 7,600, and honorarium is 15,800. 15,800. Then this is 85,600. So we need to see how much it is. It is what? 4, 2, 11, 19, 25, 2, 9, 14, 19, 1, 2, 3, 11, right? So 1,19,524 is an income that needs to be considered separately. So now you calculate your what? Business or profession. Business profits. So we can call it as income from profit and gains of business or profession. So this will typically be 1039,774. 1039,774 minus 119,524. So 920,250. 920,250. So this becomes your 774 minus your 119,524. Yeah. So 920,250. Okay. So that becomes your income. So your total becomes this is 724, 724. This becomes 200. Okay. I'll just write it properly. So 39,724. So because of that, this becomes 200. Okay. So 920, 200. Go to your business. 920, 200. Then come to your income from other sources. You can write a separate note as such. So these three things, right? these three things only will be considered as IFOs. So I'll just, for time being, for working purposes, I'll just add it here itself. So whatever it is will be your income, that is 10,524 plus 7,600 plus 15,800. So otherwise you need to separately work out as this, separately work out as an annexure. So you'll have to put a note 2 and write. You'll have to put a note 2 and write 33,924. So what will be the total income now? 33,924 plus 920,200 plus 57,920. So you have 10, 12, 12,044. So what is the chapter 6A deductions available? So we said chapter 6A needs to be worked out. We said there is what? Sorry, the question says you have ATC that is dependent on majors and dependent on amounts to 5,000, and this is one thing that needs to be considered. So ATC is 70,000. So we can take a 70,000. Deposit of total ATC is, she has invested 10,000. So 10,000 is your ATC limit. So you take this as 10,000 plus she has 80D also. When it comes to 80D, what did we say? Major son dependent on. So we only spoke about minor son. So that is what is only thing. So that is only that we need to consider. So there is nothing in 80D because it is paid in cash, and major son and brother are not actually considered. So we'll have to actually ignore it and say only this 10,000 needs to be considered. So now the income will be 10,02,044, right? 10,02,044. This is only will be a total income. So with this, probably we have computed the total income. So it needs both total income and tax payable. So we'll take a short 10-minute break, come back, compute the tax payable regular portion, also work out 115 BAC. So we'll take a short break right now for 10 minutes. Yeah. So welcome back. So as some of you pointed, as I've corrected it, it's 57,820, and just adjusted every numbers according to it. So I'll just answer some of the questions alone with respect to this. So far, whatever we have worked out. So it's basically the question is whether point here requested here is to understand the salary, whatever we are disallowing here today, whatever we are disallowing today, because 40A3 says any cash expenditure greater than 10,000. So it is not nothing to do with salary. It is basically any cash expenditure more than 10,000 needs to be disallowed. Only for transporters, it is allowed to be paid in cash, provided they have furnished van. So for that reason only, we are disallowing this 30,000. So that's what this 30,000 is. So with that, I'll just see, is there some other question that I need to answer? Yeah, I guess that is the thing. Other thing related to AMT, I guess I've explained. So yes, there is one question on alternate minimum tax. What if the second year is also alternate minimum tax? Yes, the total credit will be carried forward. So the second year credit will be for the next 15 years. So for every year, if you have AMT credit, you can carry forward for the subsequent 15 years. And whether depreciation on car for personal use can be claimed? No, it cannot be used. Generally, car, both the maintenance expenditure and the depreciation is only to the proportion of business use. It shall not be allowed on the personal use. And one question, Sunil, basically, Dubey, basically what happens is the ratio, that is 100 by 90, whatever we have specified here, this 100 by 90, the 10 is TDS under section 194I. So if you are going to do it for 194C, you will have to apply 100 to 98. So this is basically the TDS rate. So that's how we need to do the proportion of 100 by 90. Can you explain the PGBP computation? I guess it's all in order. So basically the first step is disallowance, salary, the purchase of motor car and the municipal tax is disallowed. And then you have value of benefits in kind, as income is added. Then two reduction, that is expense considered and income considered separately. So I'm providing depreciation for 12,000 and the income from other sources is separately provided. 85,600 and rental income of 119,524, and this, I guess everything is covered there. So that is about it. So we'll move on to calculating the tax. So for calculating tax, we can say computation of tax payable of Miss Purvi, right? Purvi for assessment year 22-23. So now what this provision says is, so this says basically is, again I'll have to have particulars. I'll have two amount columns if required. So typically it is, first is I'll have to calculate tax. So if assuming for the first 2.5 lakhs, first 2.5 it is nil. Next 2.5 it is 12,500. Next 5 lakhs it is 1 lakh. So the balance is what, 920,200, right? So for the balance 420,200, it is 30%. That is 12 lakh, 1,20,000, 1,26,000, 1,26,60. 1,26,000 into 30 is 60. Just see if I'm right. I'll just do it in calculator also. 420,200 into 30%. That is 126,060. Yeah, I've done it right. So the total will be 112,500, 212, 238, 560. So 238,560. On that, there is no surcharge. So add health and education cess of 4%. So 238,560 into 4% will be 9542. Oh, sorry, I'm calculating for business profits. Extremely sorry. So the actual balance income is how much is here, right? So it's 10,01,944. So it is 10,01,940. Okay, so I'll have to round it off to nearest 10. So for the balance will be 5,01,940, correct? 5,01,940. So on 5,01,940, I calculate 30%, which is 150,582. So it's 150,582, 523. So the tax payable will be 263,082 into, so which is 273,605 less he has paid advance tax of 70,000. So it will be 2,03,605. So that will be the total tax payable under this particular. Again, I've done a mistake here. I'm really sorry. So the balance is actually 10,01,940 minus 10 lakhs. So it is 1,940. So 1,940 into 30%. So that's what we need to do. Really sorry. So 1,940 into 30% is 582. So which is 1,12,000, 1,13,082, right? So and 4% will be 1,13,082 into 4523. So the total will be 117,605, right? 117,605. In that you reduce 70,000. So you reduce 70,000, which will give you 47,605. Now there is an assumption that you need to make here in this problem. So typically when you say this dividend income that you're receiving, there is gross and dividend income. Whatever is that, probably you can say that TDS has been deducted on that. So TDS on this UTI gross will be into 10%. So this will be 10% TDS. So you can take credit of that. Income particularly on thing. Similarly for dividend also, it is what it is 10%. So for both this, you can claim TDS and also account it in the book. So typically when you know a section as TDS in that income, you can actually apply. So and then apply it so that you can also write it in a note saying that, so the TDS also will needs to be considered. So it will be 10% of your dividend income, which is 1052, which is 194 section, plus 760 under 194K. That is your unit trust of India, your mutual funds. So any mutual fund is covered under 194K. So 194K it is 10%. So this put together will have 1,812. So that also needs to be adjusted. So 1,17,605 minus 71,812. So you get 45,793. So any taxes can be rounded off to 100. So 45,710. So 45,790 will be the thing. So both the income and the tax can be rounded off to the nearest 10. So 45,790 is your total tax payable. Now we need to say under section 115 BAC also, is there any other change with respect to 115 BAC? So we'll see for section 115 BAC. So I'll write first house property. There is no change in house property because there is no loan or something. So you take as it is, right? You take as it is. So your house property was 57,820. So you take 57,820 as it is. PGBP. In PGBP, whatever you need to do is basically no adjustment. So you take as it is. So if you actually see, probably we'll do it this manner also. There is nothing that needs to be adjusted for. So you don't have any adjustment. You don't have loss from house property. You don't have standard deduction. You don't have 35 AD additional depreciation, etc. So whatever is income is accounted under your regular provision is also applicable this. So the income under 115B also will be 10,01,940. Okay. So the tax will be first 2.5 is nil. Second 2.5 is 5%, right? It's 5%, so 12,500. Next to 2.5 is 10%, so that becomes 25,000. So that is, with this you have what? 2.5, 5, 7.5. Then you have 10. So for this, next to 2.5, you have 37. 5%, 10% is 27,500. Then you have for the next 2.5 it becomes what? That is 0%, 5%, 10%, 15%. So it will be for the next 2.5 it will be 15%, which will be 25,000 plus 12,500. So 37,500. So you have calculated up to 10. For the balance, 1,940. For the balance, 1,940, you get 20%, right? So you get 20%. So it will be 1,940 into So only thing is you will add here is the 80C will be removed. So that is your 10,000. So your income will be 10,11,940. So your total income, only thing that you're removing is your 80C. So it will be 10,11,940. So for the balance 11,940, what percentage you apply? You will have to apply 20%. So that will be 2,388. So now the total will be 77,388. So this 77,388 plus you add cess of 4%. 77,388 into 4% is 3,096. So your tax will be 77,388 into 1.04. It will be 8484. So this 8484, you reduce advance tax, you reduce TDS, that is 70,000. And then TDS was 1812. So 8484 minus 71,812 gives you 8,672. rounded off to 8,670. So that's how you compute both 1 phase here. So 1 by BAC, you either compute repeatedly. So what you can do is again write house property, PGBP, IFOS, get the GTI, less what is only allowed. What is allowed is only, there is no provision allowed. Only thing that is allowed is 80 CCD2 and 80 JJAA. So if there is anything, you calculate that, identify net total income. That is your total income. So you can approach this or take the actual thing, whatever is computed yearly. And so I prefer this approach. So this is preferred approach. So what you can do is, since you have all the number, you write it repeatedly and say what will be your gross total income. So in our case, you have what? Each number that you're talking about, 57,820, 57,820, and PGBP was 920,200. IFOS was 33,924. 33,924, you get your gross total income. Whatever is the gross total income was what? 10,11,944, right? 10,11,944. So in this, there is nothing that is allowed. So 10,11,944 rounded off to 10,11,940. So you do this, then calculate the tax. So that is how you do. So now you'll have to write a conclusion saying, since tax payable under section 115 BAC is lower than the tax payable under regular provisions of Income Tax Act, the assessee, Ms. Purvi, may prefer tax payable under section 115 BAC. And if you want, you can also write what is the process. She can exercise the option before filing return of her income, and she can, at any point in time in the future year, she can opt out and opt in again. So you can also write that. So there is no restriction. Since she has business or profession, we'll have to say if she is actually opting out, she again cannot opt in for the rest of the time the business is there. So since she has business, we quote that she has to do it. Since business or profession is there, she can use it for this previous year and the subsequent year as well. So she does not have the option to opt out in the subsequent year. In case she opts out, it automatically will be treated as that she is no more eligible for 115 BAC. So you can write that as a conclusion note and then complete the question. So that's what it is, right? So I guess, in case if you're writing this answer at that time, if you don't remember any section number, it is more or less okay. See, preferably, I guess you should know at least important sections. At least the important section you should know. For example, standard deduction is 16. House property, your standard deduction is 24A. Your interest in house property is 24B. So at least important section, cash expenditure is 40A3. So whatever is important sections, preferably there will be what, at least only 20-25 sections that are actually important. So that sections at least probably you can remember it and write it in the exam. Rest of the sections, if you do not know, if you're not sure about the section, just write the content alone, just leave the section number. It is okay. Do not write the wrong section numbers. So that's what is important. So now the question, see, Parsha questions that, see, the dividend income and UTI income is already says grossed. So why do we deduct TDS? So typically what the point is, in your accounting, you book it as gross because TDS is only later point in time accounted. So when a P&L says gross, it is an assumption that TDS would have been deducted. Since it's P&L, TDS is not forming part. And we know the provision, right? If it is dividend, if it is more than 5,000, TDS must be deducted. If it is mutual fund unit also, TDS is deductible at that 194K. So when you know the provision, it is always better that you assume that TDS would have been deducted because it's a transaction which is subject to TDS. So that's why we take an assumption that TDS would have been deducted. Moment it says gross, it's accounting. It's for accounting, they have accounted gross. So that's what we need to do. So this question, like whatever you have studied across the sections will apply here. So you compute each head, you calculate total tax income, you calculate the tax payable. So whatever you have studied across the thing is what it is there. Now in this section, the alternate minimum tax will not applicable because alternate minimum tax is applicable only when you have deductions under section, the heading C, that is JJAA QQB. I guess we had worked out a small number to understand AMT alone. So whatever for AMT we studied, see this problem is like an exercise itself. So this itself is like an exercise where you say your total income is 32 lakhs. You are calculating adjusted gross total income and then applying. So this itself is like an exercise in thing only. So it's like a problem for your alternate minimum tax only. So I guess we can actually use this as a problem for alternate minimum tax itself. Section 115 BAC and regular tax, we have to opt the higher between AMT and regular tax, we have to opt the lower. For 115 BAC, we choose whichever is lower. See, we'll actually do it this way. I'll actually write a point. See, 115 BAC, benefit of assessee, whichever is beneficial to assessee, that is regular tax, AMT. So, what you call 115 BAC. So here you choose whichever is lower because as an assessee, I prefer paying lower tax. As an assessee, I prefer paying lower tax. So regular tax versus 115 BAC, whichever is lower. But the AMT provision is for department. We'll call it as income tax. So benefit of government. Okay, so for benefit of government. So what will government expect? Government will expect you to pay more taxes. So in this case, it is whichever is higher. Whether this question we can solve by alternate minimum tax, there is no point. Since we are adopting by 115 BAC, since we have adopted 115 BAC, AMT will not apply. Since we are adopting this, AMT will not apply since we have adopted 115 BAC. In case if we are not adopting 115 BAC, then we can check AMT also. For example, moreover, this is also there, right? Your income is less than or equal to 20 lakhs. So in this case, AMT is not at all applicable. Your income is less than 20 lakhs and you don't have any provisions under section those provisions whichever we are talking about. So straight away you are applying the this 115 BAC or regular tax alone. So I guess we cannot apply AMT in this particular section. Yeah, see, Parsha, the cash basis and mercantile basis does not say that you will have to account TDS also. Cash basis and mercantile basis, the difference is only about whether you need to book the entry at the time of receipt or at the time of accrual. So that only changes. The concept of TDS does not change for the thing. So probably they would have, let's say for accounting purposes, the dividend would have been accounted as let's say the bank which is giving a company which is giving dividend is Infosys, the entry would have been or let's say when you're actually receiving dividend, it would have been, you would be accounting the dividend, right? You would be accounting the dividend. So let's say a particular demat account debit to dividend account. So you will account the gross amount 100. When you're actually receiving the dividend, you will receive after TDS. So your entry will be dividend account, your entry will be bank account, TDS account to demat account. So it will be 90, it will be 10 and this will be 100, right? So this will be your entry. So bank account debit, TDS account debit thing. So whatever we are discussing this will be in your P&L as gross. So this will remain in cash also. In cash accounting, what would have been the entry? You will still book dividend. Instead of demat, you would have dividend, you would say bank account. So this is mercantile. Okay, you're first accruing and then receiving it. In cash, what you do is, in cash system, what you do is, you do bank account, TDS account, directly to dividend account. That is 90, 10, 100. So the cash accounting and mercantile account, only whether you are taking into a payable or receivable and then bringing it, or directly booking under P&L only will change. Everything else will not change. I actually did not say gross means TDS not detected, net means TDS detected. What I was actually trying to say is, gross means that they have accounted the actual income. Net means they have not accounted the actual income. So that is one. Whenever you are doing a P&L, you will have to book it in gross, irrespective of whether TDS is deducted or not deducted. So the rightful assumption is saying that TDS is deducted. Whether for all questions we need to calculate 115 BAC, only if your question says. Probably in the next question that we are going to see, it will specifically say that 115 BAC shall be ignored. So in that case, you need not calculate 115 BAC. So only if your question says calculate 115 BAC, calculate it. Otherwise, don't calculate. So if your question has to be silent. So in this question, the question only says compute total income and tax payable. Then you will have to compute both regular and 115 BAC. If required, you will have to calculate AMT also in this case. Okay, in this case, if it's required, you will have to calculate AMT also. But if the question says ignore 115 BAC, then you can ignore. So that's what it is about. Okay, hope I've answered your question. So I'll move on to the next question of there is a Y who is carrying on business or profession, which is basically, so Y is actually carrying on a business, which is own business. An analysis of his trading and profit and loss account for there is revealed. The net profit was 11,20,000. The net profit was 11 lakh. Sorry, just give me a minute. Yeah, sorry, it automatically started reading. So Y carries on his own business. An analysis of trading and profit and loss account reveals the net profit was 11,20,000. The net profit was 11,20,000, and then the following income were credited in the profit and loss account. So dividend is credited, interest from debenture is credited, winning from horse race is credited. So as I told you, whenever we are doing this, we'll have to see deductions under 194, and then this is also like 194A, and then you have winning from horse races, that is 194BB. So we need to see all these sections. It was found that some stocks are omitted, so there is an adjustment to closing stock. They are saying there is a difference in opening stock. Opening stock needs to be adjusted by 8,000. Closing stock needs to be adjusted by 12,000. Just go back to your 12th standard accounting. Just remember which side is opening stock, which side is closing stock. Closing stock is like your sales. Opening stock is like your purchase. So when you say closing stock is 12,000 and opening stock is 8,000, go back to your 12th standard accounting and see what will happen to your P&L, whether profit will increase or profit will decrease. Profit will what? Profit will increase because closing stock is more. So you will do 12,000 minus 8,000. So 4,000 will be the increase in profit. So what you need to do in income tax, increase the profit by 4,000. So that's what you need to do. 1 lakh was debited in profit and loss account. So as far as your this goes, I'll just tell you the exam format. So when you're doing in the exam, what you do, you need to say that you need to reduce it from PGBP and you need to add it to income from other sources. You also give impact to TDS. So I just put a mark called TDS, or I'll call it as TDS. Now interest on debenture minus plus TDS. Horse race minus plus TDS. So I compute so that whenever I'm working a problem, Once I go through my question and see whether I have made all the adjustments that is required. Stock found, I only need to adjust in the P&L. So I need to opening stock and closing stock. I need to give adjustment to this. So my income will go up. My income will go up by 4,000. 1 lakh was debited to the profit and loss account, being contribution to university approved under notified. So whatever adjustment that you need to do for your business or profession. Technically, for scientific research, as far the provision goes, 100% is an eligible deduction. So whatever is already provided in the P&L, I need not do anything. So I only give a note. Salary includes paid to a 20,000, extent of 2,500. So which is what? 40A to B. So I need to add 2,500 because it is 40A to B, where if you are paying excess expenditure to related party, that is disallowed. Advertisement expense include 15 gift packets of dry fruits costing rupees 1,000 per packet presented to important customers. So what happens here? So typically we are saying whatever is given was advertisement. Whether you can make advertisement expenditure by giving gifts to customers, you are very well done. So no one says advertisement expenditure in kind, that is whatever you have gifted to customer is not allowed. So you only have to write a note saying it is an eligible expenditure. You need to see what I'm doing. I'm reading each line, each word, trying to understand the provision. I'm not trying to solve the problem now. I'm only trying to understand the question. Please imagine, please know that the first step of your for solving a problem is understanding the question. So first understand the question and then proceed. So now you have to provide a note. Total expense on car was 78,000. The car was used for both business and purpose. Only 75% was business, which means for the balance 1/4, it is personal. It is not an eligible expenditure. So what should I do? I should add miscellaneous expense included in 30,000 paid to A&Co, a goods transporter operator in cash on 31st January 22 for the distribution of company's product to the warehouse. So whether cash of 30,000 is allowed to a transporter? Yes, because only for other than transporter, 10,000 is the limit. For transporters, there is no limit. It only says PAN should be furnished. And there must be an eligible transporter under section 44AE. So I only have to write a note. Depreciation debited in the books was 55,000. So I need to add that. Depreciation in accordance to Income Tax Act is 15,000. So I need to reduce that. So I need to add depreciation. I need to reduce depreciation. Drawings accounted for 10,000. Drawings is not an expenditure coming under P&L because drawings is what? Personal expenditure. Drawings is personal. So it doesn't come under P&L. So I need to disallow this. 15,000 was debited in the profit and loss account for investment in NSC. It should not be an expenditure there. I need to add it. But however, I can claim deduction under section 80C. So I'm putting it as C. So just note very minutely in your question paper, do not write in detail section number, nothing. Of total income of Mr. Y for assessment year 2022-23. So the presentation matters to make sure you are having everything in place. So you'll have to write a heading, then have a table with particulars, note and amount. So everything that you do in your answer sheet should specify the valuer that you are doing. You have written what you know. You have not just written something. You have written the things that you know, whatever relating to the Income Tax Act. So that impression you will have to give it to the valuer. So you'll have to give an impression to the valuer that it is that the student has written the examination by knowing the provision. So that impression should be given by your presentation. It is not about the handwriting. It could be as bad as mine also. What is important there is the presentation. That is the content that you have written, not the handwriting. Okay. So this amount, whatever we are writing here, is now typically what you'll have to consider. So we'll start with each one of them. So we'll have to see what all income he has. He has business or professional income, and then he has income from other sources. He does not have any other income. So whatever he's having is only two of these incomes. So we can straight away work out here itself. If you have multiple heads like 3-4 heads, maybe give note. If you have only 1 or 2 heads, then straight away compute it. So we'll start with from business or income. So we'll start with net profit. So what is your net profit? Net profit is 11,20,000. So first step, what? Add expenses disallowed. So that is the first step, right? So you go back and add what? We are talking about adding. Okay, this is income, so we'll come back to that later. The first expenditure is this 2,500. So to whom has he paid? Brother, right? Salary to brother under section 40A to B. Okay, so that is 2,500. If you want, you can write a note, put 1 and write a note saying under section 40A to B, any expenditure made to a related party in excess of fair market value, in excess of market value, shall be disallowed in the computation of income. So the 2,500 being in excess is disallowed. So this could be a note. So what impression it gives the valuer? It gives an impression that you have a grip on what you have actually written. So that impression is what you need to register. Once you register that in the first few pages, that will carry out through the rest of the pages of your paper. So please transfer the impression to the valuer that you know the provisions and you have written something. That is what is very critical. That confidence you need to give it to the valuer. So that is your first thing. Now you have completed this, you strike this off. So that is the first thing. Then what else you need to add? Personal expenditure of car, right? Personal expenditure of car. So how much is it? It is 78,000. The car was used for both personal and official uses. So we need to add now this whatever car that we are talking about, 1/4. Car personal use. It was what? 78,000, right? Yeah. 78,000 into 1/4, that is 25%. So 78,000 into 1/4 will be 80 minus 500. So 20 minus 500, that is 19,500. So that is your addition. So do you have anything else for addition? So now this is done. Depreciation debited in the books. I'll have to add that. Drawings accounted. So I'll first add drawings. Personal under section 37. So 37 says any personal expenditure cannot be allowed. So whatever it is, I'll give it. You can write a note also. Any personal expenditure is not an allowed business expenditure under section 37. So both this car personal use and drawings all come under that section 37 because it is for personal use. So how much is it? Drawings. How much is the drawings? It is 10,000, right? It is 10,000. So you take this 10,000. Then you have what? Debited to NSC investment. So that is also not allowed. Investment in NSC, 15,000, right? And depreciation. Depreciation is 50,000 is what? 50 or 55? 55. 55,000 is what provided in the books of account. So these are all what disallowed expenditure. So now you take this as a total. This is 21, 22, 32, 47, 97, 1,02,000. So you get 12,22,000. So that is your first step. Then we'll have to come less. Sorry, not less, add. So first two additions, income considered. So in the income considered, so now we have done this drawings, we have considered this, we have considered this. Okay. So now coming back to the question, for the income that needs to be additionally considered, you only have this closing stock. So we can say that stock omission, right? Stock omission now being considered for income tax purposes. That is 12,000 minus 8,000. So it is 4,000. You can add a note if you want and say that closing stock is 12,000. This stock is 4,000. So that is how you have arrived at 8,000. So 12,000 minus 8,000 is 4,000. So that is what is there. So now moving on, we'll have how much? 12,26,000. So 1226 will be your income. And then you need to continue with the third step. The third step is reduction. Third and fourth step is reduction. Reduction of what? Expenses allowed. Okay, expenses allowed. So now we have computed this closing stock. So what are the expenses that are additionally allowed? Is there any expenditure that you are additionally allowing? There is no expenditure that you are additionally allowing. But one thing that you need to probably you can specify is relating to the scientific research, right? So we said you can write a note for scientific research. So what you can do is you can say scientific research. Scientific research, say as note 2 and specify in the note that 100% has already been provided as expenditure in the profit and loss account. Hence, further deduction is not required. Further deduction is not required. See, this concept was earlier applicable because there was this weighted deduction of 125%, 150. So what you do is you provide additional deduction of this 25 and 50%. But currently, there is no such provision from last year. So whatever you do is you just say the deduction has already been provided. 100% deduction has already been provided. So nothing further deduction is not required. So 12,26,000. And apart from that, we are actually taking now any income less income considered separately. That is income considered separately, right? So we need to include all those dividend income, debenture income and other things. So what are the income? Dividend, interest on debenture and horse race. Dividend, debenture, horse race. So these are the three incomes. How much is the amount? 22, 17,500 and 15,000. 22,000, 17,500 and 15,000. So what will be the total? Total will be 39,500, 49, 54,500. So with that, you get what? 12,26,000 minus 54,500. 26,000 minus 54,500. That's 11,71,500. So that becomes what? That becomes your income. Now, apart from this, sorry, probably, yeah, you can do that separately also. I forgot this depreciation. You can either include depreciation here itself, saying depreciation allowable under section 1962 Act. Otherwise, 1960 Income Tax Act 1961. Otherwise, what you can do is You can do it separately also. So less depreciation 50,000. So 11 lakh 21,500. So that becomes your what? PGBP. Then you have IFOs. IFOs is 54,500. Okay. So now this depreciation, probably you can write a note. See, technically there is this question called 75% of motor car is only for business purposes. So you can write a note stating that whatever is eligible depreciation has already been considered under that 50,000. So it's an assumption. Otherwise, what should you do? You should calculate the motor car depreciation, but you don't have the motor car value. So, but just to clarify that you have taken a position, you can write a note saying depreciation under Income Tax Act is assumed that it has disallowed the proportion of personal use. So you can give that as a purpose, give that as a note so that it will help them understand. So that is what is there, and then you get your gross total income. Gross total income is what? Will be 1175,500. So that's what this income is about. That is 1170, 1170, 75, 70, sorry, 76, 1176. 11,76,000 is your total income. Now you need to provide for deductions that are eligible. So deductions less Chapter 6A. So what is Chapter 6A? Chapter 6A, you had only one, that ATC, which are, so now you have done this. You'll write a note. This is also done. Depreciation is done. So this is also done. ATC, that is 15,000. So you provide this 15,000. So your net total income, your total income is 11,61,000, right? So 11,61,000. So that is what the question says. Compute total income. It is not asking you to compute tax. So when it's not asking you to compute tax, you need not do. When it is not asking you to compute 115 BAC, you need not do. So when you are asking to be only compute total income, the concept of AMT, nothing comes, because AMT comes only when you need to calculate tax. So when you have to only compute income, you need not do anything related to alternate minimum tax or this number also. Yeah. So with that, this problem is over. So I'll just see if there are any questions that I can answer. Why demat account is credited? That account, okay. See, basically, you need to, when you're booking a receivable, you need to book the party. You actually need to book the company which is supposed to give you dividend, or the demat account, let's say HDFC account or whatever. That is why I've just debited here. So this is purely for accounting purposes. So just forget it. So demat account which I'm debiting is, I'm trying to say, in accrual, in mercantile system of accounting, you will first book it to the debtor or creditor. Any income or expenditure, you will route it through a debtor or a creditor. So this becomes a debtor. So debtor, and when you're receiving it, you credit the debtor, so that you knock off. So that is why I've actually put demat account. And this interest on debenture is, it is someone of you pointed, Gayatri, you're right. The interest on debenture is actually on security, so it fall under 193, because 194A is only interest on other securities. So that is 193. So dividend is 194, interest on debenture is 193, and winning from horse races is 194 BB. Namrata, whether we can write in question paper is like this. So that's what I'm saying. just have a minute mark in pencil. That is still okay. So no one will say anything. If you are making a very, very small mark in pencil, all you're going to do is just put a small minus plus probably things like NT and or something. So just to make sure that you have actually done or something, just to give you a reference, it can be in pencil, very small mark, very small mark. You're not supposed to underline, strike off, write the section number, nothing of that kind. But a small minus plus is still okay in pencil. In pencil, just see that it is done in pencil. So that is okay as far as your question paper goes. Gayatri, yeah. See, the question says it is part of the drawings. Drawings is not at all part of P&L. Why should we do it? But it says that it is part of your P&L. So whatever information they're given, they are saying that it is part of P&L. That is why we are actually adjusting it upward. So when it is not in P&L, yes, you're right. It need not be adjusted at all. Depreciation point, please repeat. Namrata, what I was telling is, see, the car is actually used for both business and personal purposes. So what happens is there is a probability that the depreciation relating to your personal use also should be disallowed, right? So that is also a possibility. But we do not know whether the Income Tax Act 1960 and under the Act 1961, whatever was specified, there is 50,000 after adjusting personal or before adjusting personal. So technically, we are assuming that whatever cost is only whatever depreciation is after adjusting personal use. It's an assumption that you are taking. Because even otherwise, you will not be able to compute the depreciation for personal use because you do not know what other assets they add. Rakesh, we are not adjusting ATC from PGBP. What we are doing here is we are removing that whatever we are talking about, the investment in NSC, we are removing this and then providing here a deduction. So we are just removing it from the business or profession and providing deduction. Deduction is not head based, it is your total income based. So it's not head based. So I guess that's what it is. So I'll upload anyways this whole sheet which has other problems also. So you can go through the other problems also and see if you can try working out. Any questions or something, you can get in touch with the institute on how to, in case if something has to be posted, you can get in touch with them and let me know if there are any questions. So, sorry, with that we'll wind up today's session. So please, practice only makes you perfect. So keep practicing more and more questions. When you start, a problem may take you 45 minutes. But by practice, it might even be able to finish it in 20 minutes. So please keep practicing more and more questions. Probably try all the questions in your study material. So that only gives you a complete control of the subject. So please be confident and make sure that you write every question with that confidence, saying that you know the provision. That only will help it. I'm sorry. So thank you all for the wonderful session. With that, we'll wind up this session. Wishing you all the best for your income tax, for all your intermediate examinations. So thank you. Yeah, concluded. Thank you.